What's up, traders? It's Matthew Mickey, and in the last video for this section, we did the first step of our idea generation, and we found an economic tailwind, right? And the economic tailwind says that there's still a lot of room in the energy market. So as everybody's trying wolf in a deflationary pivot, like I say no, right? I am going to do my due diligence still, even if I'm wrong. I still have to go through the repetitions and do my due diligence to get better at this process, right? So we are traders, right? Whether the sky is falling or not, like, it is our job to find the trades out there. We manage risk through position sizes and stops, and then we, hedge our longs with shorts to prevent crappy timing, right? So we're traders, right? So we need to know when it's time to day trade the ES and try to capture the weekly or the daily range. We know when we want to be vol traders and capture some of that risk premium, and we know when it's time to manage a long short portfolio and grab some of that volatility from a 30 to 90 day range, right? So let's get it, let's go. So in this trade setup, we are trying to capture a quarterly shift, right? I'm saying that there's going to be a quarterly shift within the energy market that makes the energy market go up for the next 90 days until March or April timeframe. And so now we're going to drill down into the industries and figure out what the industry catalyst is going to be, and then we're going to find the industry outliers, and then we'll go into the company and we'll figure out what the company catalyst is. Okay, so this is the OIH index, and we're going to look at some of the research that came out from the McKinsey Research Institution to see if we can find what the catalyst for the industry is going to be. So the following chart shows that U.S. fracking crews are flattening out, which means they're slowing down, and that the jobless rates in the oil and gas industry is at the lowest level since 2005, right? Why is that? Because growth since 2020 was largely driven by wells that were already drilled but uncompleted, right? After the U.S. accounted for the majority of global oil supplies growth since 2010, the burden and increment new supplies will have to shift outside the U.S. with offshore oiling, right? So basically what they're saying is that the U.S. has reached max capacity of production, and that means the rest of the world will have to increase their production and start covering down. Remember, we talked about in the economic catalyst video that the current administration is not going to let them complete those wells that need to be drilled, and that kind of puts a kink in things because they keep taxing the production, which means why would I produce CapEx and when all my free cash flow yield is going to get just taxed out, right? And I'm going to have all these ESG restrictions on us. Remember also that like we told Europe and Asia to stop buying gas from Russia, right? So now we're facing lack of supply, and there's going to be a demand from China reopening, right? So demand with the lack of supply, we already see that world will face shortage in the national gas. Some forecasts are showing that Europe will be out of national gas by 23. But the first clue to figure out what industry within the oil and gas production that we just got was, we have geopolitical tensions, we have restrictions from a political standpoint, and it just gave us a huge hint: offshore drilling. We can see that we're hoping that Norway and Canada will likely attract some of the new attention for production, but we'll see. They have their own ESG regulation, and they have the similar, political figures in-house. Right, so now let's move on to the next part. Like the Baker Hughes global rig count, which is a lagging indicator, but the second biggest company in here, right, it's nearly doubled from the 2020 COVID lows, but despite this, it still remains 50% over the 2014 highs, right? The rig count is likely to continue to increase as the Westwood Energy Group forecasts that the number of wells drilled could increase roughly 21% from 49,000 in 22 to 60,000 in 26, right? The one thing I want to point out to this is like we haven't even recovered production in the rig count since, like, we haven't even returned to the 2020 levels, the pre-COVID levels, right? When it comes to fracking and production, right? And we are still 50% below the 2014 levels, right? Refining and fracking is expensive, right? Why deal with the headaches of increasing your production if you own one of these companies, or even hiring people, and the government is going to fine you and tax you for all your profits. Okay, moving on, the sub-industry aha moment, right? As we're looking through what this consultant says, it says that the deepwater oil production will be the fastest growing oil and gas resource sector through the end of the decade, growing by a cumulative 60% by 2030, right? It went from producing 500,000 barrels in 1990 to 10.4 barrels this year, and is forecasted to exceed 17 barrels in 2030, right? As a share of total output, deepwater is projected to grow from 6% of total upstream output to 8% by 2030, right? And then it also talks about, the consultant also estimates that the ROI, return on interest, investment in deepwater projects database averages 24% using a Brent benchmark price of $60. The best returns come from smaller projects that are blank. We'll hit that up later. But the aha moments here is, right, the forward-looking indicator states that deep water is where we need to be. That's the industry. We already identified the why, and the why is because oil production must happen. There's a lack of supply currently in the world due to geopolitical nonsense. There's a demand due to China reopening and just the demand of oil that Europe and Asia needs due to the Russia embargo, right? And voila, deep water, right? It's the aha moment because it falls under international jurisdiction and it's harder to regulate with ESG, red tape, and taxation, right? And why I'm not an investor, right? I'm searching for a 30 to 90 day, profit from this, right? 2023 is when deepwater will start outstripping its peers, right? And that's what I'm targeting, right? If we look at the break even, it shows that we are at a discount in this trade, right? And remember the COT commercial hedging program I was talking about earlier? That's in the last video. It shows that the selling happening lately has been speculated. It's not due to the oil majors selling, and it's probably due to price being so close to contango. So that's it, right? So now we take the economic tailwinds, and now we are breaking it, and we found the catalyst from an economic standpoint. Now we just found the sub-industry that we need to get into and what the catalyst is going to be with that. Hopefully this is helpful. This is the edge. Why are we discounted, right? We already talked about the break-even, and we can see that the offshore oil and gas projects in the production have a resource-weighted average break-even price of $18.10 per barrel of oil equivalent compared to $28 for onshore projects, right? Now, the rest, you can look at the chart to get more of a understanding of this, and then the second side of the chart on the right side I'll go into once we actually identify our company, because some of those have to deal with the catalyst and I'm trying to target at a company level. Alright, so now let's see what we have to play with. First thing I look at the PE ratio, and a lot of people show me on this, but I want to know what the market's spending their money on right now, right? So I look at the next 12 months PE, PE1, PE2, and I expect to see a drop from next 12 months PE from to PE1, which is fine. And the first thing that glances my eyes, I want to see PEs higher than the average, right? WHD and FTI, right? Those two have the two highest PEs in this industry group, and the PE F1, you can see a decline in both of those, right? Which is a good signal, right? And then I want to make sure that next 12 months PE outstrips the price and sales, right? And as we can see, it does, right? All right, then I go over to the earnings growth, and I want to see solid earnings growth, right? Earnings growth 1, we can see FTI has 517%, WHD has 33%, and then going on to earnings growth 2, I want to see earnings increase in it, but because we're this close to the beginning of the year, usually you're going to see higher earnings growth for F1 than you will for F2, right? And then I'm going to do the same thing, so both of those look good, right? And then I'm going to do the same thing for revenue that I did for PE versus PE sales. I want to see revenue for F1 to F2 increase, which we don't see in neither one, but I definitely want to make sure that earnings is outstripping revenue, right? And then I want to see a higher peg, so WHD wins that one, and then you can see an increase in WHD's peg 2, right? And then I'd go over to the EV over sales, EV to EBITDA, same concept. I want to see EV to EBITDA outstrip EV sales. I want to see positive numbers. All right, so those all forward-looking indicators that tell me that there's forward growth in these two companies, right? Now I'm going to go to gross profit margin, and we can see that WHD has 33% gross profit margin. Oh yeah, and the stuff that we look at now is just to confirm the earnings, the forward-looking indicator. These are backwards-looking indicators pulled from the balance sheet, the financial statement, and the cash flow sheet to show us that the earnings growth that we're projecting is going to be balanced by legit backwards-looking finances in accounting, right? So we can see that the two companies I like have good gross profit margin, like above 20% is good for this field. And then a must for me in this current market environment is free cash flow yield, right? And we can see that both have 2.25, 2.29%. All right, looking at the return on asset, WHD has 9% versus FTI's 1%. Return on capital, WHD has 21% over FTI's 3.2%. WHD has 19% return on equity versus a negative 4.53 on FTI. So right now I'm leaning heavier on the WHD, right? EBITDA to interest. So do they have enough to pay off their long-term debt and their short-term debt, right? You can see 307 to 1.21. Your quick ratio, WHD has the higher one. Your net debt to equities, you can see that WHD has negative 4.2, where FTI has 70, right? And then moving on to the market cap, FTI is a $5 billion market cap versus WHD, which is a $2.8 billion. So FTI is a little bit stronger in the business cycle. Short interest, about the same. Total debt to EBITDA, WHD has a better one. The beta, one's 0.85 to the S&P 500, and one is 1.42. And then which one gives out a dividend? WHD gives out a 1% versus a 0.10% with FTI, right? So those are the two companies I will move forward and do the quantitative analysis. I'll go through their earnings call. I'll see what the analyst targets are. I'll check out leadership of the companies, and then I'll find the catalyst and the key price indications to see which one I want to get in a play on. All right, guys. Hopefully this helped. Later.